In this video I'm going to talk about an Australian property market update. It's February 2020-21, and I know so many of you want to know whether this is the right time to invest in property or not. So I'm going to talk about whether this is the right time to invest in property or not in residential real estate in Australia. So hi, my name's PK. I help people invest high growth, positive cash flow properties without using a buyer's agent, without dropping $15,000, without spending their weekends at inspections, without even touching mainstream websites like Real Estate and Domain and RP Data, CoreLogic, all through using data. So let's get into it. Now, the first thing I want to talk about is the stimulus. Now, everyone is saying that there is so much fiscal policy, which means the government injecting a lot of cash through various methods into the economy. A lot of people saying that there's lots of monetary policy, which means interest rates very low, and also the Reserve Bank buying government bonds. What that means, just to kind of simplify it down, is when the government wants to pump money into the system, whether that's by reducing stamp duty, or whether that's by reducing income tax, or whether that's through infrastructure building or any handouts whatsoever. And we know that ScoMo's been doing a lot of it, quite rightly so. They need to fund it. How are they going to get all this money? So what they've been doing is the Reserve Bank has been lending the Australian government billions and billions, hundreds of billions of dollars, right? And that allows the government to have lots of money to be able to pump into the economy to kind of lift it out of its coronavirus kind of sluggish state. And it's actually doing remarkably well. I'll come down to that in a second. But the number one question that I have people asking is, you know, property prices are increasing, but isn't this an artificial bubble? Isn't by the economy being upheld or buoyed by artificial money, isn't that an artificial sense of what's going on in the economy? Isn't this all just, you know, upheld, buoyed by something that's not real? And yes, that's absolutely true. It's not real. It's not fake, but it's not real. It's not organic strength in the economy. But what's happening right now is it's much like when you have a car that needs jump starting, or not jump starting, you know, it's like the battery's dead and now it needs, you know, a little bit of a push, a bit of power to just kind of get it humming again. So that's what the government does when things go into a recession. They pump money into the economy, the car starts to roll, the engine starts to cough, the engine starts to splutter, but then it hits its gear. And that's exactly what's happening in the economy. And everyone's saying, but this is all artificial. Well, it was artificial, but once the economy gets into a rhythm, it's not artificial. So it was based on something that was artificial, but then it kicks into gear. And then the other, the sort of argument is, well, you know, what if it's a bubble? What if the housing market right now is a bubble? What if it's all just going to come crashing down like a house of cards? We just need to look at history to see what's actually happened. Now in Australia, we've been quite fortunate that we've not actually needed to do that much monetary stimulus, that much fiscal stimulus in the last 10 to 20 years. But if you look at economies like the UK, if you look at economies like the US, you just have to go back 13 years in the global financial crisis, and trillions of dollars were pumped into the economies, and trillions of dollars were printed by the central banks. Does that money ever need to get paid back to the central bank? Now, this is modern monetary policy. I can geek out on this for a long time. But in essence, the truth is the government, whether it's in Australia or anywhere around the world, does not need to pay the RBA back. What would it accomplish by paying the RBA back? It would have to increase taxes. It would take money out of the system, out of the economy to pay the RBA back. And it's not like the RBA is a profit generating center. Its job is to help the economy. So why would the RBA ask for money back when it would hurt the economy? It's counterintuitive, right? So what has actually happened in the world in the last 13 years is that so much monetary policy by printing money has been stimulating the economy. And you can just look at the US. I mean, Trump goes on about how they had the best economy before coronavirus, and it's kind of true. And it was all based on the fake money, the monopoly money that the Obama administration pumped into the system after the GFC. And what happened? The car got into a rhythm, it started humming, and it was driving very fast. And so that's what happens. And do you think that the US government has paid back the Federal Reserve much money from all that money printing, from all those government bonds that it bought? No, absolutely not. And that's exactly what happens around the world. This is you could say, the beauty, it's not my word, the beauty of modern monetary theory. You can print money endlessly. Endlessly you can print money. The governments can access money without having to pay it back, especially well-regarded, highly rated governments like the UK, Australia, New Zealand, the US, etc. So that's a long-winded way of saying that even though, yep, it's artificial money, we're not in a bubble, because the bubble isn't going to burst. There's no point at which the government will need to say, guys, I need to pay this $200 billion back to the RBA. Everyone's taxes are going up. You know, we're no longer going to support jobs. We're no longer going to support the property market. We're no longer going to support unemployment coming down, all this stuff. It's not going to happen. And this is the kind of debate that has gone on for decades and decades and decades. And in the last 20 years, it's really been proven, if you look at the literature, that although it's fake, it works. Although it's fake, it actually works. So what the European banks did after the GFC around 2011, 2012, was they actually said, we're not going to print money. The ECB, the European Central Bank, said, we're not going to print money. We're going to try to get the car humming again, just organically, without any assistance. And it was a colossal failure. So if you guys remember, back in 2012-ish, Greece was going bankrupt, Spain was in turmoil, all these kinds of things. And the ECB then said, hang on, this is not a good idea. We need to print money. We need to buy government bonds off these countries. We need to inject money. And all of that money is not really being paid off, right? And it's helped those economies. Now, not as well as the UK, US, and Australia, but that's the beauty of being a AAA rated country. You can basically print money endlessly to get you out of these troughs, back up on top of the hill, and that's exactly what's happening. So right now, as I record this video, every single city market in Australia is experiencing property price increase. So you want an Australian property market update? Here it is. Everything is going up. That's a bit of a flippant statement. Darwin has gone up in the last 12 months by more than 10%. Sydney has gone up. Brisbane has gone up. Perth has gone up for the first time after a long time. Adelaide is performing super, super strong. Everything has gone up except Melbourne. And this year, 2021, Melbourne will start to go up. So the economy is actually doing remarkably, remarkably well. Inflation is still not too high. I mean, it probably will get higher, but it's coming off such a low base. There is no risk for hyperinflation in the next couple of years or even the next 5 years. Could it happen in the long term? Maybe. I have no idea. No one really knows. But in the next 5 years, we're basically fine because inflation has been so subdued. Wage growth has been so subdued in Australia for the last 5 to 10 years that massive inflation is not really a risk. Okay. Unemployment has been coming down. They expected it to go up to 15%. It never did. They expected it to go up to 12%. It almost got there. Now it's back down to 7% and dropping. The stimulus, the monopoly money, the fake money has really worked. Australian house prices are going nuts. So if you are actually on the ground, it's one thing to kind of be an armchair philosopher and say, oh, look, what's going to happen? But I encourage you to actually figure out what's happening by looking at the data and by, even if you want, go to a couple of auctions or go to some houses that are for sale. See what's actually happening. It's actually really hard. You can ask me because we're buying there a lot at the moment. It's actually really hard to find to buy good properties in places like Sydney. I mean, I have so many people saying I'm finding it so tough because the listing price is $1 million, it will go for 1.1 every single month in places like Western Sydney, in places like Mount Druitt even, in places like Campbelltown, in places like the Ponds, Bella Vista, Glenmore Park. All these areas are in Sydney, what to speak of the East. You know, every single month prices are going up by $10,000-$20,000. That's a reality. It's not me making stuff up. You can check this out for yourself. The same is happening in Brisbane. The same is happening in Adelaide. Melbourne's a little bit more timid. Hobart still continues to go forward. I've been saying for a long time that it's about due to stop going up, but it still goes up. Perth is just rampaging. It's actually really hard. Perth is in a lockdown right now, so a good opportunity to buy property. But once again, there's like 50 people bidding for the same property in good parts of Perth that are growing. So overall, like, we're not in a property bubble. We are not in a property bubble. They said we were in a property bubble in 2009 when property prices started to increase on the back of the stimulus that was injected post GFC. They said that we were in a property bubble in 2014 when Sydney, Melbourne house prices really started to boom. They said the bubble crashed in 2017 when prices came down 10%, but a 10% correction is not a crash. Now prices are at or even beyond those 2017 levels after coming down and back up, and prices are increasing. I mean, if you know what you're talking about, you'll know that prices are increasing very, very fast. So my perspective on the economy is that this is a very, very, very strong economy. Prices are increasing like they would have last year had the coronavirus not happened, and prices increased last year anyway. So imagine what it's going to happen. When I look at the data, when I look at things like job advertisements, when I look at things like days on market, when I look at things like average vendor discounting, you know, what this smells of is the 2016 boom. Now, of course, there's always good pockets to buy, bad pockets to buy, good cities, bad cities, good streets, bad streets, good, you know, suburbs, bad suburbs. But on aggregate, the property market is booming. And you've seen my other videos, you know that that's not kind of a thing I like to say because it seems very spooky. Everyone else says it. I don't like to say it. Let's qualify that. What constitutes a boom? What constitutes a boom, in my mind, I don't know if this is right or wrong, is when property prices go up by more than 10% in a year. Right? That city or that suburb has experienced a boom. It's what's happened above average. It's booming in Adelaide. It's booming in Perth. It's booming in Darwin. It's booming in many parts of Sydney. It's booming in many parts of Brisbane. Not everywhere. Brisbane's particularly sketchy. You need to be very careful. It's not like the whole city is booming. I've done another video on that. Northwest, southeast, a few pockets. But it's doing remarkably well. And if you're on the sidelines thinking, you know, this is artificial, this is based on fake money, you need to really understand economics, because you just need to look at history and what's happened after every time there has been significant government injection. In 2010, when the economy was bolstered in Australia, Sydney house prices after 2 years went up 20%. And that amount of government injection pales in insignificance compared to the tens of billions, hundreds of billions dollars of injection in the economy right now. So you might say that, hey, okay, well, prices will increase for the next 2 years, PK, they might boom, but then they're probably going to crash. But here's the thing, when you jumpstart a car, when you give it some momentum, once it's jump-started, even though the car didn't start by itself, it required another car to kind of G it up. Once it gets that momentum, it doesn't slow down. It just carries on and carries on and carries on until you get to your destination, and then it stops, right? So that's how property market will work. The next few years is going to be brilliant. I think, and I'm not an expert, well I am, but I'm not. 2025, 2026, when unemployment will reach, let's say, between 4 and 5%, down from 7 to 8% right now. That is the target which the Reserve Bank governor is saying that is when they'll start to increase interest rates. Okay, so when interest rates increase, that means it's harder to borrow money. That means investment dries up to a large extent. That's the purpose for interest rate increasing. They try to slow the economy down because it's getting overheated. They're not going to do that. The Reserve Bank has said that very clearly for the next 4 to 5 years. So this is the window. The next 4 to 5 years is the window in the next 10 to 15 years in Australia for you to create wealth through property. When interest rates were coming down between 2010 and 2000, well now, especially between 2010 to 2016, that is basically 50% of the reason for the Sydney, Melbourne markets to boom. That's 50% of the reason. It's not immigration. Immigration was already happening in the first part of the in the first decade of the century. It's not like immigration kind of just skyrocketed. It's interest rates that made the big difference. And if you look at statistical analysis, if you look at the autocorrelation, if you look at the regression analysis going backwards, you'll see that 50% of all capital growth that's occurred in this decade, or the last decade, 2010 to 2020, was because of interest rates reducing. It has such a massive impact on your ability to get loans. And I mean, it's very clear. If you can get a loan tomorrow versus if you couldn't get a loan, now there is more demand in the economy. So when interest rates reduce, more people can afford loans. When interest rates increase, less people can afford loans. So the next 5 years is when interest rates are going to be flat, record lows, basically 0%. This is the time for you to get positive cash flow property, to ride the growth as long as you buy the right suburb. Not everything will do well. It never has, right? And this is the opportunity for you to really create some passive income, because I'm a little bit pessimistic, but between 2025 and 2030, you could say, those 5 years, or 2025 to 2035, if the economy does super well, it's kind of a catch-22. Interest rates will start gradually increasing because they'll try to slowly put the brakes on the economy so inflation doesn't rise too much and mean that everything becomes unaffordable. So that time, 2025 to 2035, it will be harder to grow wealth because it'll be harder to generate the demand in the property market because it's harder to get loans. Okay, getting a loan is the most important factor for demand. If you can't get a loan, you can't, even if you want a property, you can't buy it. So that was a bit of a rant. It wasn't super structured, but to conclude, this is not a property bubble, and if you disagree with me, just let me know. But I mean, we'll see what happens in the next 3 to 5 years, and history has a tendency to repeat itself. So if you want to know what will happen in the future, study the economic history, and especially the econometric history of the modern world, especially in the last 10 to 15 to 20 years. Don't just look at economics, look at econometrics, which means the statistical analysis of how macroeconomics works. In other words, when monetary policy happens, when fiscal policy happens, what impact does that have on asset classes, especially property? If you go and do your analysis, you'll find that we are not in a property bubble. I'm not a PhD. I'm not an economist. I mean, I have a degree in economics, but I'm not an economist, but I know how this stuff works. So you can make the most of it. You can get into the property market, or you can be like everyone 20 years ago, 15 years ago, 10 years ago, 5 years ago, 2 years ago, in the middle of coronavirus, a year ago, saying the property market is about to crash. And what has it done? It's more than quadrupled in the last 20 years. So I'll leave it there. If you got value out of this, just give a like or a love. Hit subscribe if you're watching it on YouTube to get more videos just like this. You can see the production quality is not fantastic. I'm kind of in a random creek waiting for my wife to get a haircut just a couple of blocks away, so I thought I'd record this video. But leave a comment below if you disagree. Leave a comment below if you agree, if you have a different opinion, especially if it's backed up with facts. That is more important. Comment below and we can start a discussion. But hopefully that was useful, and I'll leave a link below on how I have an agenda on how you can actually make money in the next 5 years, some very significant passive income. by buying the combination of growth and positive cash flow properties. We've done it hundreds of times, too many times for it to be guesswork anymore. If you want my help, I'm here to help you. If you don't need my help, good, do it yourself, but make sure you invest because you're going to make a lot of money. Catch you later, guys. Bye.